Again, we're going to have a bit more time at the end for some kind of round-robin questioning. The next speaker, Jennifer Ralph Oppold, will be talking about the business implication of hedge fund regulation. Jennifer is a graduate of Princeton, then later Harvard, then later Harvard. We won't hold it against her. She currently works on the research team at Select Equity Group, small mid-cap focused on short-term investment fund activities. Welcome.
Okay. Thank you, Professor Donaldson. Let me just get my presentation pulled up here. Do you have the clicker? Great. Okay, now I'm all set. So good afternoon. I think that I'm the designated industry representative here today. And as such, I should start out by saying that my presentation and views here today reflect my own views and not those of my fund. So typical cautionary statement. And as you can tell, I'll be looking at the economic impact of hedge fund regulation today. Okay, there we go. So we've actually already heard quite a bit about industry growth today. I don't think we didn't see all of the presentations before we came, so I'll skim through these fairly rapidly. But I'd like to give you a broad outline just to demonstrate the rapid industry growth and as it affects the hedge fund as a group economic influence on the global economy. So, as you can see, to start off with, the number of hedge funds has experienced rapid growth at approximately a 20% compound annual growth rate, which is really quite rapid. And going forward, the assets under management have also grown at approximately the same rate. Hedge funds today are estimated to have approximately $2 trillion of assets under management, although estimates range from 1.25 trillion to 2.5 trillion. As several other presenters have mentioned today, it's notoriously difficult to get information in this area, and so those estimates do vary. While this is a significant number, it's not as large as it may initially appear. For instance, the mutual fund industry in 2005 had almost 18 trillion under management, and so you can tell that it's still a fraction of the total asset management industry. This growth rate is likely to continue. Institutional investors have been increasing their allocations to hedge funds, and hedge funds in Asia and Europe have been growing assets under management at a 40% annual compound growth rate the last 5 years, according to a study by McKinsey & Company. So, moving on, I'd like to show you just a sample of a range of hedge fund investment strategies. These strategies are premised on basically the antithesis of the efficient market hypothesis, because these reflect different areas where managers believe they can bring some advantage to the market and take advantage of some different form of arbitrage to make a profit, essentially. A fund will typically only focus on one strategy, such as emerging market securities, although a firm may collectively offer a number of different strategies. For instance, the same hedge fund may have different funds that are event-driven, invest in mortgage-backed securities, or invest only in emerging markets. And by that I mean, for instance, I work at a fund called Select Equity Group, but within that fund structure, you may have a wide number of different funds with different strategies. The purpose of having these individual funds is to give investors the ability to have exposure to specific segments of the market. Clearly, that individual fund is not diversified, but the idea is that the investor can obtain the diversification they seek by investing in a specific basket of asset classes. So basically, you move the diversification to the investor level rather than at the fund level. Now, moving forward to the core of my presentation, basically to point out the reason I demonstrated industry growth to start with is to point out the increasing economic influence of hedge funds. And so to begin with, these are estimates from Greenwich Associates, and they collected recent data on hedge fund trading volume in a number of fixed income asset classes. Overall, hedge funds only account for 18% of fixed income institutions, but they represent 29% of fixed income trading volume. And as can be seen, here are a few specific classes. In distressed debt, hedge funds account for 86% of estimated trading volume. and emerging market bonds 54%, and so forth. Earlier today, we heard an estimate from Professor Booth that hedge funds account for 40 to 50% of total market trading. As you can see, this means that hedge funds represent a significant source of market liquidity. The combination of hedge funds' growth in assets, use of leverage, and active trading strategies gives them a clear impact on the economy. First, their direct impact. The use of leverage gives hedge funds a greater economic impact than their asset levels would imply. The example of long-term capital management has been brought up several times today. They were levered approximately 25 to 1 at the time their holdings began to decline, and many funds are leveraged 2 to 3 times. Long-term capital management had approximately $5 billion under management, but a market impact of almost $125 billion, which is why regulators were concerned about systemic risk when the fund came near to failing. Moving on, the prime brokers, which provide hedge funds with services such as trade consolidation, custody, financing, and back office technology, earned $7.5 billion as an industry in 2005 and $11 billion in 2006. McKinsey estimated that in 2006, hedge funds collectively spent $33 billion on corporate investment banking. This $33 billion number includes the full value chain of banking services utilized by hedge funds, such as research reports, trade execution, securities lending, financing, custodial services, cash management, reporting and analytics, and advisory services. Finally, hedge funds also have an indirect impact on the economy due to the revenue earned. And this has already been brought up several times. The typical fee structure is 2 and 20, and there is a wide range of fees within that, but that's become somewhat what the industry is known for. And while collectively hedge funds don't earn astronomical figures, there have been managers who have been known to take home paychecks of $1 billion or more. In a simplified example, a $1 billion fund with a 10% annual return would earn 2% of assets under management, or $20 million, plus 20% of its $100 million gain, for a total revenue of $40 million. This leaves investors with an after-fee return of 6%, which is the standard which should be compared to benchmarks and other funds. Eddie Lampert of ESL, James Simons of Renaissance Technology, and T. Boone Pickens of BP Capital have all personally made over $1 billion in their best years. In comparison, the CEO of Goldman Sachs earned $54 million in 2006, one of Goldman Sachs' best years. Now, moving on, Professor Doug Cummings spoke in detail this morning about international regulation of hedge funds. But I would like to quickly review their typical place of domicile and some of the political issues raised by the growing economic influence of hedge funds. So this slide shows data from a 2005 study by Liang and Park, which demonstrates that hedge funds are domiciled globally. Incorporation in tax havens such as Bermuda or Bahama is common in order to minimize taxes. Offshore funds are particularly appealing to non-U.S. citizens and tax-exempt investors. It is difficult to obtain accurate estimates, but observers estimate that 43 to 80% of hedge funds are incorporated offshore. Note that a manager will often have 2 funds with identical investment strategies but different domiciles in order to meet the tax preferences of different investors, such that it's effectively one fund in that you make the decisions, the investment strategy the same way, but you'll basically execute 2 sets of trades for the funds, and they'll be domiciled and have different prime brokers and so forth in order to meet what's really the investor's tax preferences. So moving forward and going on to basically the political ramifications of this economic influence, you can see that the growing influence of the hedge fund industry has made them a target at times of political concern globally. To start with, and this was actually mentioned in our introduction, the Malaysian Prime Minister blamed George Soros' fund for destabilizing Malaysia's currency during the Asian financial crisis in 1997. Similarly, the German government protested TCI and Atticus Capital's successful activist battle to prevent the Deutsche Börse from taking over the London Stock Exchange in 2005. The chairman of the Frankfurt Stock Exchange accused TCI of ripping out the heart of the German economy, and the vice chancellor described hedge funds as locusts. More recently, in January 2008, The chairman of the Lone Star Funds was banned from leaving South Korea for 10 days due to controversy around its 2003 purchase of KEB, a distressed state bank. After turning it around, it stands to make $4 to $5 billion in a sale, which is HSBC has actually proposed to offer it, and it stands to collect a $4 to $5 billion profit on that deal. And so, as one might suspect, there are quite a few concerns with the fact that they purchased it at what now appears to be a considerably undervalued amount at that time. And finally, last summer, German Chancellor Angela Merkel made hedge fund regulation a key topic at the June 2007 G8 meeting. Okay. And finally, moving forward to the regulatory outlook. We've already been through this with a few other presenters, so I won't dwell on it, but I wanted to briefly point out that the U.S. does set tight restrictions on other forms of investment companies, and specifically the Investment Company Act, which applies to mutual funds, and actually hedge funds are exempt because they use the private offering exemptions in 3C1 and 3C7. You can structure, we won't get into the details, but you can structure your fund in different ways to ensure you fall into those. And some of the specific limits there apply to leverage, the illiquid securities you can invest in, and they set diversification requirements. If you recall the slide I had earlier in my presentation with the wide range of hedge fund strategies, this would fundamentally make many of those strategies impossible. And so just to keep in mind that basically that the existing that we do treat mutual funds and hedge funds very differently. I think everybody here is aware of that, but just a reminder. And now moving on to some of the common issues which are being considered by regulators globally. Regulators are particularly concerned with leverage because of the increased systemic risk that accompanies it. As the term suggests, systemic risk is derived from events that threaten an entire financial system, not just individual market participants. And long-term capital management is probably the most famous example of that. I won't dwell on it longer since I think people are pretty aware of the events there and it's already been spoken of. With retail investing actually raises several fundamental questions. Basically, does wealth equal financial sophistication? Has modern technology democratized the availability of investment theory such that a person who earns $100,000 may actually have the financial sophistication of somebody who earns $2 to $5 million because they have that information at their fingertips? The U.S. has actually moved further away from the approach of other international countries on retail investing, As it stands now, and we've already been through this, but only accredited investors with an income of over $200,000 or net worth of over $1 million can invest in hedge funds under the Securities Act of 1933. The SEC has proposed raising that requirement to $2.5 million in investable assets. And by the way, the most critical part is that that figure would exclude home equity. So currently, many people reach the $1 million standard because given the appreciation in home prices, it doesn't take nearly as much to hit that benchmark as it used to. But this $2.5 million figure is not only higher in just sheer empirical terms, but it's also fundamentally a different number because it would exclude home equity. And so it would really raise the bar in terms of which investors would be able to make it. Other countries are taking a less paternalistic approach. Singapore and Hong Kong have lower minimum investment requirements, allowing almost all investors access to hedge funds. Germany has also opened up its hedge funds to a greater extent, and the FSA in the UK announced in March 2007 that it intends to allow retail investors broader access to hedge funds. We've also, empty voting turns out to have been a popular topic today, and so I won't dwell too long on it, but I would like to point out, well, as Professor Hugh mentioned, it's a practice of using derivatives to separate economic ownership from voting power. And I think I had some other notes prepared, but I'll skip over those. I'd just like to point out, however, that a natural limit on empty voting is Section 16C of the Exchange Act, which prohibits short selling from any entity owning 10% more of a corporation's stock, and also prohibits short swing profits for those 10% holders. These restrictions make it uncommon for most hedge funds to build a 10% plus stake. And as he mentioned the example of Perry Capital, you may have noticed that they had a 9.9% stake in King Pharmaceutical. And there's definitely a reason there. And so one thing to keep in mind in terms of the overall empty voting discussion is that this rarely represents 40 to 50% of the votes, although, all of these, the use of derivatives evolves so rapidly that what may seem not possible today can easily become so in the future. So who knows where that will go. And finally, we could discuss varied disclosure standards. And I won't get into the wide range of different companies' approach, but just a reminder, the United States requires investment managers with more than $100 million under management to file what's called a Form 13F within 45 days at the end of each quarter. And Warren Buffett has actually protested this. The SEC is entitled to give fund managers a longer period in which to file this. And Buffett used the example that basically there was a temporary spike in security prices following his filing. And he didn't always have time, Berkshire Hathaway didn't always have time to build the position that they wanted to build before having to file this. And so Goldstein, of the famous Goldstein case, has also protested this on the basis of it being his secrets, I think the term secret sauce was used today, or proprietary formula, such as he analogizes it to Coke's proprietary formula for their beverage. So you can see that although I think most of us would agree that what the US currently has is a disclosure light regimen right now, it's still not necessarily controversy-free. So finally, last slide, how am I on?
You're doing fine.
Okay, great. Good. So currently, international regulators are moving towards a principle-based rather than rules-based approach to hedge fund regulation. And what I mean by that is an example of principle-based regulation would be, quote unquote, safe levels of leverage versus a rules-based leverage versus rules limiting leverage to 3 times assets under management, to pull a random number out of the hat. The UK specifically is moving towards voluntary disclosure and self-regulation. An industry group has put together a proposed group to be called the Hedge Fund Standards Board, which will be financed by the industry to promote best practices and promulgate voluntary guidelines. The proposed rules ask that managers either comply with the standards or explain to investors why they have refused to do so. And I guess the opt-out approach was mentioned earlier. They're essentially adopting that, although, as a reminder, this is a voluntary organization at the same time. And so while they request that people either explain or opt out, it's yet to be seen how that'll be taken and whether firms will actually follow through with that. I think what's most interesting to note about this, though, is that this group has been in close consultation with the U.S. Treasury and several working groups that have been mentioned earlier today within the U.S., because there really is a convergence, particularly between the European markets and the U.S. markets in regulation, as it's being realized as hedge funds are domiciled all over the place. These asset flows can move very quickly, as was seen during the Asian financial crisis. And increasingly, people realize that unless there's a common regulatory approach, you will likely see an increase in forum shopping if there do become very different standards. I'd like to finish by mentioning that there's a couple of natural market checks that can help to limit systemic risk and serve to mitigate some of the concerns involving hedge funds. First, counterparty risk gives banks and other counterparties incentive to ensure that the hedge funds they deal with can make good on a transaction. Particularly with things like swaps, that's very counterparty specific, and so you're going to do a little background work, hopefully, or you're basically not a sophisticated investor to ensure that the other party can hold up their end of the deal. And empirically, banks cut back on the availability of leverage post long-term capital management, and also this year after the decline in subprime mortgage values. So you do see market pullback in times when basically banks begin to be concerned whether they're extending too much leverage, and this is a natural reaction without needing to set a hard cap. Finally, the President's Working Group on Financial Markets is expected to issue proposals for the United States in spring 2008. So this is expected to follow the FSA's recent approach and be more of a principle-based approach. Post-Goldstein, and as has been discussed earlier, the SEC has really moved away from trying to set specific rules. The reality is that hedge funds are one of the most mobile industries, as they can relatively easily change where they are domiciled. National regulators have somewhat limited power to act unilaterally, as assets will move abroad if they attempt to tighten controls too much. This in turn put the billions of dollars that hedge funds feed into the economy at risk. My argument is not that hedge funds should not be regulated, but that we should think carefully about the economic impact of any proposed regulations, and keep in mind that the regulatory approach taken by other countries, given the mobility of hedge fund assets, does affect the long-term outlook of our own economy. So thank you very much, and I am open to questions.
Great. And yeah, questions? Yes.
Somebody argued that the current financial market meltdown was caused by not because of subprime mortgage, but because of the hedge fund. Because, as you know, hedge fund derivatives, right? The exact pronunciation, but it's one of the most significant methods to invest, manage their portfolio of hedge fund. So, what's your opinion about the relationship between the derivatives and the hedge fund, and then derivatives, derivatives.
Oh, derivatives.
CDOs, something like that.
CDOs.
And then, as you already, my second question is you recommend the bank or prime broker as a counterparty, such as gatekeeper, is very one of the possible approach to regulate the hedge fund industry. So what about the opinion, implementation of Basel II approaches?
Okay, well, let me start with your first question, and then I may have to ask you to repeat elements of your second question. But to begin with, do I think that hedge funds and the use of derivatives have particularly impacted the subprime mortgage issue? And first of all, as you may remember from my trading volume slide, yes, hedge funds are certainly one of the most active traders and account for significant liquidity in this market. So they are most definitely involved. But I do not think that they fundamentally caused, when you basically look at what's happening with the subprime mortgage issue, it goes back to much more fundamental issues with the availability of easy credit, the rapid appreciation of U.S. homes, and a number of other factors. And when you look at where hedge funds have fallen out on the spectrum, it's the same wide range as other investors. If you look at basically the two hedge funds that Bear Stearns had that went bankrupt versus a hedge fund that was on the front pages of the Wall Street Journal within the last month was Paulson, which earned a return of almost 600% this year by basically betting on the triple B sections of the tranches that they would fall. And so I think that hedge funds are certainly involved, but I think that they didn't create this crisis. Some of them made a lot of money, some of them lost a lot of money, but I don't think that I would necessarily put the blame at their door, so to speak. I don't think, they're not the reason, basically, that subprime mortgages have fallen so rapidly in volume. And as to your second question about banks being, the implementation of Basel II in banks, I didn't quite catch the thrust of. Could you repeat that second part?
Yeah, but Basel II, the implementation as the.
How do I think that'll affect hedge funds? So basically, it changes the capital adequacy requirements that banks have to obey, and I think it could most directly affect hedge funds basically by how much they're willing to lend to them, and so it could impact the level of leverage that different funds are able to utilize. But I think I don't think it'll fundamentally change. I think a broader question right now is, as you see banks have to make huge write-downs and get equity injections, I think that fundamentally limits, and you've seen credit markets dry up, that's going to limit the ability of hedge funds to obtain the financing to use leverage to a broader extent than the implementation of Basel II, in my personal opinion.
I mean, if I could follow up on that just a moment, ask the final question in this segment. You suggest that banks as counterparties may be a natural check, a market check on, for want of a better term, hedge fund stupidity and recklessness. Banks don't strike me as playing that role very well historically. I mean, all the way from the federal savings and loan debacle to Latin American debt to most recently the subprime mess, we note that bankers are rewarded short-term, and yet the implications of their decisions are long-term, leading Martin Wolf, an economist writing in the Financial Times, even to suggest that there should be some restriction on the remuneration of top bankers, forcing them to hold some of that remuneration throughout a period that will reflect the performance of the decisions they made. How would you respond to that?
Well, I certainly can't disagree that for what we think of as being probably some of the most sophisticated financial institutions out there, it's surprising by how often banks have tripped up and fundamentally needed to be bailed out to a large extent or otherwise. And I don't disagree with the proposal that it is important to tie that short-termism is a common complaint against hedge funds as well. And I think in general, as we look at our economy, it's worth thinking about how we can move away from that short-term focus, particularly when it comes to things like fraud. And I mean, most recently, at least to me, the subprime mortgage fallout has really demonstrated that the short-term profits can really lead to, long-term, deep-seated problematic issues for our economy. And so I don't disagree with you, but I don't have a perfect answer either.
Yeah. Okay, well, thank you very much. Our final presenter is Scott Yusuf. The topic of his presentation will be advising hedge funds. He's well equipped to talk about that. He represents corporations and individuals in federal and state court litigation. His clients have included Merrill Lynch and Company, where he successfully defended Merrill Lynch against charges by class action suit charges that alleged misleading research analyst reports contributed to losses. Welcome, Scott.
Thanks. Thank you, Professor Donaldson. And I particularly enjoyed Professor Talley's take on Dabbitt versus Merrill Lynch. I was involved on the team that took that up to the Supreme Court, and it's nice to see the effects of your case beyond just direct legal implications. When I saw the oral argument date of January 2006, it reminded me of a story that has absolutely nothing to do with what we're talking about, but since I'm last, I'll take the liberty of telling you anyway. So we were inside preparing that morning for the argument. My wife was on the line to get into the oral argument. It was a long line. It was a cold, rainy, wintry morning. And the guy behind her says, "I really hope I get in today. This is my third trip to D.C. I haven't gotten in to see an oral argument yet, but I scanned the dockets for the most boring case I could find, so I think we'll get in." So it sums up that the pinnacle of my professional career to the rest of the world is their most boring day. But I think it certainly keeps your feet on the ground, keeps you humble, and you realize that not everything focuses around the stuff that we
It was an exciting day for me, Scott.
Thank you. Thank you. And I was going to save this for the end, but one question I do have for you is whether a hypothesis for the increased volume might be, and I think Professor Booth might have an interest in this, is that decision helped cure what, at least on the defense side, we view as a flaw in the securities litigation realm, and whether the market perceived that these riskier companies now are going to face less frivolous actions and less of a drain, and therefore, even I agree with you, I don't know if that's going through somebody's mind, but implicitly it becomes a safer investment. And perhaps a study comparing post Dura, post Stone Ridge, or some of these other cases that now that the court's taken up an interest again in securities litigation, might be an interesting control to see if that might be another reason that would justify the volume. But I did find it fascinating to see that in play. Well, I'm going to try and give a little bit of a practicing lawyer's perspective on some of what we've discussed today. And as Jennifer gave her little disclosure, I will too. These are my views and not necessarily Skadden's. And the more I think about these issues, I'm not even sure they're necessarily my views because they keep changing from time to time. And right up front, I think as the day started with Professor Booth being a little skeptical of the need for regulation, I'll be candid, I'm in that same camp. However, I don't think any of that means that we view the hedge fund world as being some kind of Wild West, anything goes environment. And I think that balance between the two will hopefully come through in some of my thoughts. Advising hedge funds presents a lot of various unique challenges that you don't always have with other clients. As we heard today over and over again, there's really no one-size-fits-all for hedge funds. They come in all different shapes, sizes, colors, and that goes for the funds and the problems they face and the issues they face. And that goes everything from, you have to treat each fund and each situation as its own unique set of facts, and you can't just apply what you applied on the last go-around. That goes everything from a fund's documentation that governs its standard of care, its board of directors, all the way through advice you end up giving on day-to-day operations of a fund. I think one of the things that exacerbated the challenges that practicing lawyers face in advising hedge funds is what we heard today about the tremendous growth of assets under management, and just the size of these funds have become enormous, and the growing complexities of the investments and the investment strategies that they engage in. So along with that comes just a tremendous amount of new issues each day. And why is it such a challenge? Well, first, a lot of fund managers that now that they're in a whole new world when they're in the billions and tens of billions of management than they were when they were much smaller funds. And I think there's a transition that has to go on where a lot of fund managers aren't, for lack of a better word, aren't used to playing with that regime and aren't used to being in that world. And it's not necessarily intentional wrongdoing. A lot of times it's just things that you didn't have to think about. You have to think about a lot more as you grow. And there is a little bit still of that cowboy mentality of the Wild West. And as funds have grown, they have to be careful about that. And as to the advice and issues that we face as lawyers, I think it's important that these types of fund managers, especially in the larger funds, realize that even though you may not be a regulated entity or you may not be facing the same regulatory environment that others are, you should operate to some degree as if you are. And I think it was interesting. One of the side effects of the Goldstein decision was not only did you have a lot of funds register when they thought they had to and then no longer had to, but it was interesting how many of those funds, when they no longer had to register, still wrote to their investors and said, we intend to still abide by a lot of the requirements that they would have had to. And I think despite conventional wisdom, good business lawyers, and I distinguish between just regular lawyers and business lawyers, because I think a business lawyer tries to recognize the economic situation the client's faced in, what their business issue is, and uses the law to help them accomplish those goals, but knows that in the end, that's not the be-all and end-all, is the legal solution. It has to actually help them accomplish their business needs if possible. But I think despite the conventional wisdom, good business lawyers do not always advise, or shouldn't advise, on how best to find loopholes, how to get away with things that you're not supposed to get away with. It's far more important to provide advice that helps the client accomplish those business goals, but in a legal, ethical way that's in the long-term best interest of the client. That does cut across all clients, but it's particularly important in the hedge fund world because at the bottom of it all, what a hedge fund manager really has is his or her reputation. That's how you end up attracting money. That's how you prevent redemptions. It's not just your return on assets, but it's your reputation. And again, as an advisor, what you have to balance that with, it doesn't necessarily mean that what you should be doing is always making a super safe decision, always advising a client or a hedge fund client to steer away from the line, because then you're not doing the client a service either. You have to recognize that there's a need to aggressively and zealously advocate for your client and give them appropriate legal advice, but at the same time keeping in mind, at the forefront of your mind, the legal and ethical implications. And it's interesting because the other challenge with advising hedge funds that's different than your Fortune 500 companies is the people running the funds are often, on the relatively young side. I can't tell you, I called one of my partners who on the corporate side advises hedge funds all the time and asked him for a couple of anecdotes perhaps for today. And one he tells me is, it's no surprise that every couple of years he gets a call from some hedge fund advisor, 27, 28 years old, who goes, I have a new idea, in quotes. Let's do X, Y, and Z. And he'll say, well, I think Congress outlawed that in 1933 and 1934. It's things like that. The short-term memories, long-term memories of people that just haven't experienced a lot of things creates unique issues. And I'll just run through a couple of quick examples of issues that you face with hedge funds and advising hedge funds that are somewhat unique. There are know your client and anti-money laundering issues that actually implicate both the law firm advising the client and the hedge funds themselves. Hedge funds now are getting investors from all over the world, and throughout the world, the anti-money laundering efforts, especially with terrorism today, have been heightened. I think this is an area where there's probably agreement on all sides. It should be regulated. I think there's regulations in place that are sufficient, if enforced, to prevent that. But that is an area of advice. On the law firm side, you now have clients or potential clients knocking on your door that you've never heard of. I mean, the person sitting next to you in jeans at Pod having dinner could easily be a multi-billionaire hedge fund manager. And it's very different than it was even 10 years ago, 15 years ago, where a new client knocked on the door, especially at a large law firm willing to pay your fees. It was a Fortune 500 client. You could run a Dun & Bradstreet. Instantaneously, even before the internet, you can get enough background information very quickly to know that they're a legitimate client. Today, that's much more difficult with the rise of all these hedge funds, especially offshore hedge funds. So it's something I think that needs to be presents unique challenges in and of itself. Reg FD and insider trading issues are very prevalent issues that you need to address with hedge funds. Again, not that people necessarily are going to be deliberately trying to do things, but you have players in the marketplace now, especially funds that have grown, that have access to management, and if they're not advised properly as to what they can or shouldn't be asking and what they should do if they do fall into information that's potentially material inside information, you either can find yourself in big trouble or even creating the appearance of impropriety. And I think that's another goal as a good business lawyer, is to help your clients steer away from that. And for those of you that don't know Reg FD, it's full disclosure, it was enacted to prevent analysts and others from trying to get a bit of inside edge from talking to management. Now corporations, public companies need to give full public disclosure on information they often give to either large investors or analysts, in short. I think also as funds grow, they take on new roles. If a fund acquires a debt side, trading side to itself, there are a lot of ethical walls that have to be put in place between the debt side and the equity side of the fund, because certain, if you own debt, you're often provided with information that you wouldn't necessarily as part of your covenants. So you're often privy to inside information. You have to take extraordinary steps to make sure that's done properly. And again, at the bottom line of it, it really comes down to helping protect your reputation. Another example, as we hit the liquidity crisis this past summer, there were a lot of instances where funds temporarily needed an injection of capital in order to get past a certain period of time. And a lot of fund managers provided that temporary capital. And there's lots of ways that could be done. From a legal perspective, yes, the funds managers themselves could just take equity in the fund itself. The result of that could be diluting your other investors. So when you come out of the crisis, you've now come out ahead and you've diluted your other investors. As I think an outside advisor to the fund, as a lawyer, you could, if somebody asks about that, yeah, you can prepare the legal documentation, but it's important to make sure that your clients and your hedge fund clients know the ramifications of that, as opposed to an alternative way of doing it, which is providing it as debt with no interest, and other ways, which in the long run may improve your reputation and may be better for business. And as we talked about, the paperwork and documentations for funds is a very important aspect of funds. I think when a lot of funds are created, they don't pay enough attention to their documentation. It seems like, we'll just use, take off the shelf the fund paperwork that was done for XYZ hedge fund, and you could use the same one for this fund. And without getting into too much detail, that doesn't always work. You find out later on that there's a lot of issues with that. Touching a little bit upon the need for regulation, or the perceived need for regulation, and a lot of that was talked about today. There's a couple points, though, I just want to touch on from the practicing lawyer perspective. Again, I think there's a lot of existing regulations, obviously the anti-fraud provisions of the securities laws, common law fraud issues, other regulations that, if enforced properly, could sufficiently protect investors. Unfortunately, fraud is going to happen. It's happened from the beginning of time, and it continues today. But I think it's important to distinguish between fraud and other scenarios where people lose money. In the popular press, the financial press, and even a bit amongst legal scholarship, people seem to mention in one breath the long-term capital crisis, Amaranth with the energy traders, and then they mention Bayou and all these other instances, all with one broad brush. So in my view, things like long-term capital, while people lost a lot of money and while it may have had a deleterious impact on the economy, wasn't a fraud. It was a bad investment strategy. It was an investment strategy gone wrong that people presumably did not predict. And a lot of investors lost money, but they were sophisticated investors that made a lot of money when things were going the right way. To some degree, the same thing with Amaranth. Bayou, on the other hand, is a famous hedge fund that collapsed because of fraud, was an outright, according to what we know from reading the papers, was an outright fraud. But I'm not sure what the proposed regulations would have done to prevent that if you have somebody that's willing to lie and cheat. I mean, there's other things you could do to prevent that, but I'm not sure requiring all hedge funds to register is going to be to solve that. And I think the primary basis for that is that investors, especially hedge fund investors, are sophisticated investors. You see in articles all the time, well, pension money's invested in hedge funds. A lot of this pension money comes from super sophisticated entities like CalPERS and other pension funds that are investing in private equity, investing in venture capital, investing in hedge funds that are far more sophisticated than most investors. And as Professor Donaldson touched on, you have people like Warren Buffett who say they just don't understand the model itself. 2 and 20, why would people be willing to pay those fees? He's been very critical of fund-to-funds because he just thinks it's even more skimming off the top. And I don't have an economic answer to that, although I do wonder why sophisticated investors are willing to pay those fees if they weren't worth it. I just have to presume and take the leap of faith that the market somewhat dictates those fees, presuming there's appropriate disclosure and the like. And I think across the board there tends to be. I think some of the regulations like the recent anti-fraud provisions put in by the SEC and others, the thing you have to balance with regulation is the chilling effect, the access to these funds, the liquidity, the efficiency, the things Jennifer and everybody touched upon. And it is a balancing act because there are these unknown causes and effects that take place every time you do something different. Professor Booth mentioned options this morning as an issue with executive compensation. The way I recall it was really shareholder activists or people that were interested in shareholder protection that were the original driving force behind, you can't pay CEOs this much in cash. They need to have their skin in the game. Let's give them options. Then, after the bubble burst in 2000 and others, people said, wait a second, these CEOs were encouraged to inflate the price of their stock because they were given options. So you're sort of caught between a rock and a hard place with a lot of these issues. And I think the lawyers will always be at the front edge of both either helping to create a regulatory scheme that works, both economically and as intended. And I think lawyers are going to be there, obviously, afterwards to help advise clients on how to deal with the new regulatory scheme. And we are hitting a trend, as Jennifer touched upon, in London, the best practices groups that are getting together. So there's going to be a lot of voluntary issues that go forward to help solve some of these problems. And I think lawyers, again, are going to be at the front edge of that. And you see that even in the subprime world with the American Securitization Forum's proposal to try and help resolve some of the problems that homeowners are facing with declining house prices. It's creating a whole new set of issues because, that, for those of you that don't know, that's the proposal where you would put reset the rates on certain mortgages that are supposed to go up. But that's creating a whole new series of issues because, as the person from the audience asked the question before, the securitizations and the CDOs and the derivatives that are held by hedge funds and others are saying, wait a second, you're resetting these rates, but I'm entitled to the income from those underlying mortgages. Is that what's in the best interest of the investors? So it's a very complicated world we live in, and for better or worse, lawyers play a role in all facets of it.
Very good. Questions? Let's see. Let me make sure there are no hands we haven't heard from yet. Yes, please.
Okay, there we go. Have you talked a little bit about fees and the 20% mark, and I know that some of these funds will put in a high watermark provision to where they, if they've met certain levels of profit, and once they go below that for any successive number of years or duration of time, they've got to again surpass that high watermark level in terms of profits in order to get paid their percentage. Have you seen in advising any of these hedge funds issues arise where they maybe go through 2 or 3 years of being below those high watermarks, and then there's talk out there about the incentive to just ditch the fund altogether, upstart a new fund, and be able to start, not have to worry about meeting that high watermark anymore? They can just start fresh and have the prospect of making money that first year. Have you seen that crop up, and what kind of advice do you give, or if you haven't, what would you give in that kind of circumstance?
Right. I have not seen that in particular, although I think I can answer hypothetically what type of advice I would give, because you do face similar situations. And I think it's that it really comes back to that bottom line of protecting your reputation. And that comes up a lot when we advise funds on liquidation and what's the best way to liquidate a fund. And people close funds for all sorts of reasons, not necessarily for some reason to start fresh for fee structures. But if you do it the right way and you do it with full disclosure to your investors, there are many people that have had funds that were not successful. They liquidate them and they do it sort of in an upfront manner, and they go out on the street and they're able to raise money very quickly. And you say to yourself, in fact, the New York Times, I think, had an article the other day about, picked 1 or 2 or 3 folks that have left some of the larger financial institutions after the subprime issues and said, how come these people are able to find a new job raising billions of dollars for hedge funds while other people are out of work? And again, personally, I'm not this die-hard free market person, but I have to say to myself, if people are willing to give their money to them, there's a reason. And I think part of that is by protecting your reputation. If you do things up front, people if it's done right, investors will understand they're not going to make money on every investment. But you have to do it up front. And I think the playing around with the fees would be not the best way to inure yourself with investors. I think that may work in the short term, that may work in small situations, but I think in a large, sophisticated hedge fund, it would be a big mistake. That would certainly be my advice. I think one other thing about fees that's interesting is, or this notion that you're willing to pay these fees, yet some of the statistics we heard is that funds have only barely outperformed the S&P or Dow Jones, some of the other indexes. I think one thing to keep in mind, again, with a short history, is we've lived through a pretty bull market, even with the bursting of the bubble. I have a client who once told me that his best year that he's most proud of was the year where his fund lost 2%. And I said, what are you talking about? He said, yeah, we lost 2% when the market and our peers were down in double digits. So part of the true nature of where the term hedge fund comes in, and I think part of the best fund advisors will say, yes, when everybody's doing well, it's easy to say we're sort of in there. But when you're protected on the downside, and I think this year is going to be a very, very interesting year to see if that plays true, that's where it's worth putting in those fees. And I think that's what people recognize. I still don't understand how you could perfectly hedge anything, because to me that's keeping your money under the mattress. But certainly when you have the right correlations or lack of correlations, these folks seem to be pretty good at protecting people on the downside while still making money on the upside.
Yes.
Hi, I was wondering when you advise these hedge funds, as far as in-house compliance procedures, maybe you could give some examples of what those are actually like, how cognizant these funds are of sort of following those procedures, and particularly in regards to anti-fraud provisions and being in compliance with those.
Sure. I think that is one area, especially over the last 5 to 7 years, where hedge funds have begun to caught up with bulking up their internal infrastructure on both internal controls and compliance. I think one area, as I started to touch upon, was establishing the appropriate ethical walls and concerns about insider trading, especially as funds become more diverse. You have funds that are at the same time in the private equity sphere, the debt sphere, the listed exchanges, trading equities, and all these things create issues, and it's important to have that infrastructure. I think sometimes what a fund faces as a challenge, and maybe Jennifer could address some of this, is how much of that does the fund manager pay for and how much of that comes out of the funds themselves. And that's a whole nother unique set of issues that a fund has to face, and outside lawyers have to face. You've got to be clear who your client is. Sometimes the client is just the fund, sometimes the client's the manager, sometimes it's both, and you have to deal with conflicts and other things that arise from that. But I think for a while, funds were relying a lot on outside counsel because it was easier. A lot of managers don't like to pass on some of the management costs to the funds for various reasons. And I think it was easier sometimes if you hired an outside lawyer to pay it directly out of the funds for certain perceived benefits. I think that's changing. I think people are investing a lot more in their internal compliance infrastructure. One area especially is email retention. Even though a lot of funds now that they don't have to be regulated, don't have the same requirements to save email that other financial institutions have to. I think there's been a trend towards voluntary compliance because it makes it much easier when dealing with the SEC, when trying to defend against certain allegations of insider trading and fraud. And so as technology evolves, funds are facing unique situations all the time.
Let me try one closing question. I want to throw out a hypothesis to you. The hypothesis is that a responsible attorney representing a hedge fund as a client will, both for reasons of ethics and also reasons of representing the self-interest of the client, encourage the hedge fund to participate in voluntary industry-wide activities that self-regulate. I would note that right now the UK is doing a fair amount. The United States seems to be doing almost nothing. And as somebody who testified in the Sarbanes-Oxley hearings in the Senate a long time ago, I don't know anybody who doesn't think we overreacted with Sarbanes-Oxley. I would submit we're probably only 1 or 2 scandals away from an overreaction by Congress with respect to regulation. You think that's my hypothesis is true?
I don't. I think that again, there's always going to be people out there that are trying to cheat the system. The question is balancing that with the drain on the rest of the economy. And I think there has been a trend of capital flowing from the United States to foreign markets. I think London is now a direct competitor, if not perhaps ahead of New York, as a leading financial capital of the world. And in part, Chuck Schumer's report, who's not a right-wing zealot at all, but Chuck Schumer, and certainly has his own interest in defending New York, and Michael Bloomberg and others put together a report, and litigation and regulatory concerns was high on the list for why people are trying to avoid the U.S. capital markets.
But just quickly, I wasn't actually talking about government regulation, but industry self-regulation.
Oh, I think you will see a trend. And I think this one happened to start in the UK, this best practices trend. I think that's going to come over the pond pretty soon. I think so. I would hope so, because I think that if you do it yourself, you tend to do it better, and then you keep the government sort of out of your pocketbook. So I think I'm hoping to see that as a trend. And I do think the subprime issues we faced, again, I don't view that so much, and I'm not talking about for what you read in the paper, mortgage originations or what mortgage brokers did in terms of fraud, but from the CDO derivative side, I don't view that, again, as a fraudulent scandal. I view it as perhaps bad risk management. I view it as perhaps groupthink and other problems. I think it was a failure on behalf of certain counterparties to really know what was happening on the other side? Are these monoline insurers and others, and hedge funds and other financial institutions falling asleep at the switch a bit? And that's why I think it's their pocketbook that will drive them towards a voluntary best execution, best practices role.
Thank you very much. Unregulated, our participants did very well time-wise. And we actually have a few minutes left. The first thing I'd like to do is just open things to our panelists to see if they would like to challenge or ask questions or make comments about anything that's occurred so far.
Well, I'll throw a question open to both Scott and Jennifer. So, and it has to do with particularly what I think globally was measured as a continued expansion of the hedge fund industry in the fourth quarter of 2007, almost double what the fourth quarter inflows were in 2006. Where's that coming from? Is that coming from what used to be private equity investors that are now sort of soured on those sorts of deals, or where do you see sort of some of that uptick coming? It's still a growth industry in many ways.
Of course, a lot of this data is confidential, but I think from what at least I've read and heard is that you were really seeing assets grow in Europe and Asia, that they've been, the growth in the U.S., at least the McKinsey study that I've read, which has the most detailed data I've seen, and that actually wasn't Q407, and so, it's not the most recent, but it was really Europe and Asia that were powering the most recent growth with the, fastest growth. And the U.S. had actually slowed slightly, which makes sense as there's a larger base upon which to grow. And so as to your question whether money is flowing out of private equity, I really don't know, but I do think that you're seeing different groups, CalPERS, different institutional investors really increase their allocation to different private pools of capital. And so from what I've heard on the street, I would expect actually, you're probably not seeing allocations to LBO shops right now, just given the state of the credit markets. But I would expect that to be a short-term blip, and overall probably the allocations to all asset classes rising.
I think anecdotally, I agree. I do think, though, some of it was the private equity boom over the last 2 years or so, and the increased M&A wave was because of people having cash available to invest. And I think now there is a little bit of transfer of that into the private pools of capital, but also overseas, both because I think the currency situations we face, as well as which one thing we didn't touch upon at all today, I think, is the sovereign funds overseas. And I heard Robert Rubin speak a couple weeks ago, and he said that one of the funds he visited, I presume on behalf of his company, to get some additional capital, had $1 trillion of available capital. The numbers are astounding when you think about just taking small pieces of that and what they could do throwing around that kind of money. One of the things he raised, which is a little different than investing in hedge funds, is they could take a small chunk of that and match Harvard's endowment and create a research and educational system there that is going to be, if we're concerned about the long-term view of the United States and the capital markets of the United States, that is going to be competition when that money gets thrown around, both from an investment point of view and in other ways.
Interesting. Very interesting. Well, with that, let me open things up to everyone.
My question is more to Scott, and I'm sorry I didn't get to catch.
Speak up.
Oh, sure.
Just a little bit. Yeah.
I think it's on.
Okay. So I was wondering, while advising hedge funds, I guess, what are their fears as far as regulation? Are they willing to concede certain self-regulatory measures, and if they had to, or is there an actual market incentive for them to self-regulate?
And I think Jennifer could probably answer that from the market incentive side perhaps a little better than I do. But I do think it's a balancing act, because one of the things that I don't think we realize, but if you talk to people in regulated industries, the insurance industry, the banking industry, the amount of resources devoted to keeping in check with certain just day-to-day regulatory functions, including industry sweeps and otherwise, is enormous. And again, it's warranted in many, many areas and many fields. I'm not suggesting that we start deregulating certain areas. But I think that is the concern of hedge fund managers, especially when they're sitting there saying, I'm confused. I'm dealing with a group of investors who are very sophisticated. They know what they want to do. They're giving me, I'm fully disclosing, we have the as long as the documentation's in order and stuff. Why is it all of a sudden, because some guy in Connecticut blows up his fund, that all of a sudden I have to get dragged into this? And I think it's sort of this balancing act that people are facing.
Yes.
This kind of ties in with Shiv's question, I guess. I know, Jennifer, you said that in Europe they're hoping to institute self-regulatory measures and people volunteering information. Do you think that that's really going to work? Or, do you think it's all done in vain, or do you think that people actually are going to volunteer? Because I imagine if nobody volunteers information, then, it's kind of groupthink. No one's going to do it. And then if everybody does it, then in that case, I think it's the only way that it would work if you were an outcast by not complying with those rules. And did you, I don't know if your research revealed how people tended to feel about those and if they thought that they were going to work.
Sure. I can only answer anecdotally, but I completely agree with Scott actually about the importance of reputation in the industry. And for instance, my fund is a registered advisor and does so voluntarily, and that has a lot to do with just the reputational impact in the marketplace. And because of that, I actually I believe that voluntary regulation would probably be effective, and actually I like the opt-out strategy, the explain why if not. And maybe it's possible. I can't really predict. Maybe you do see 50% of funds saying, hey, because it doesn't. Our trading strategy makes it inappropriate for us to make these disclosures. And then I guess it'd be really up to investors so where does that drive assets? And I think that would be, at that point, an interesting empirical study to see, are you seeing, which way do you see asset flows? But of course, I think that's really a question that we can't judge until the future.
Yeah, I would add to that. I think that it's not altogether clear at all that a completely voluntary system wouldn't work if people are sophisticated enough to make adverse inferences when a disclosure is not made. But there could be a lot of reasons you don't disclose. One could be that you're essentially hiding the fact that you're fleecing your investors, that you're making terrible decisions, or that you're making these arbitrage profits only because no one else knows how you're doing it. And so that's going to be the hard part. And I don't know which way that would cut. But.
Yeah.
I don't want to suggest that also by this view that it's only a few bad apples and there's absolutely nothing we have to worry about. There clearly are. People will be aggressive both in crossing the line or approaching the line without deterrence, and there's no doubt about that. But I think one of the points that comes out today is there's a lot of tools in place that if used effectively can do that without necessarily just adding more on top of that. And I think the insider trading area is one area where I personally think the SEC and others could step up with existing regulations and really do a lot more of that. And I think some of the commissioners have recently come out with that concern. And it only takes a little bit of exposure of that, because I think investors are sophisticated and will move around to deter people from engaging in even potentially wrongdoing when it comes to insider trading.
All right, so I have another question. Sorry to be so forthcoming with questions, but I'm interested in this area as of late. But mine, in addition to maybe voluntary best practice measures or something like that, I noticed it was a 2003 case where a company that was affiliated with FINRA had an enforcement action because they didn't properly disclose their hedge fund practices, and particularly in terms of risk. And so they got fined, I think it was $175,000, which is maybe not a big deal, but my question, I guess, would be, what about that as an alternative or in conjunction with a best practices type pursuit? Do you see that as a viable way to avoid regulation and to maybe solve some of those issues, not necessarily as they relate to fraud, but maybe in terms of accredited investor type standards and how those are used?
Well, nothing's going to prevent a common law fraud action against a hedge fund, right? You're totally exposed against that. If I'm telling you I'll bring you back 45% returns, and I've done so for the last 5 years, and that's a demonstrably false claim, and I induce you into that, into that investment, that's actionable already under common law. I'm not sure you necessarily need the SEC to be filling those shoes.
No, I'm not talking, that's what I mean. I'm not talking about fraudulent cases. I'm just talking about like a general disclosure where they, I guess under FINRA guidelines, they were supposed to say hedge funds are, you're subject to these kinds of risks. I think particularly now that I recall that you could lose your whole investment and things like that, and they didn't disclose those things. And so that's what I mean. It would, in relation to the accredited investor standard and the proposed change that we talked about earlier today, something in lieu of those kinds of changes where you could kind of keep the SEC out, but if you had kind of a wholesale movement toward FINRA type, this private, I understand it's just one step away from a governmental regulation, but if it's some way where you could kind of lessen the burden on hedge funds in general, but still kind of and stave off government in the same way.
I think in the interest of time, we're going to stop right now. My sense is, I suspect it's yours, that a good bit of light has been shed on one of the most important topics of our day. Join me, won't you, in thanking our presenters.
Professor Steele is just going to have a few closing remarks.
Really just going to repeat what Tom just said. I think I unfortunately had a corporations class which caused me to miss the second panel, so I'm not going to try to describe the panel since I would only be describing the morning panel, but like any of you who had conflicts at any point in the day, or what I'm hoping to do is to get Shiv to get this online somehow so I can listen to the things that I've missed, and hopefully you all will do that as well. All I'm going to do is thank Shiv and the Journal for just a fabulous conference. This has really been wonderful, shed lots of light of all different kinds. We've had empirical analysis, theoretical analysis, real-world analysis. This has been the issue for the last 4 or 5 years at least in the corporate governance circles I'm in. That's not going to change in the near future. So I think a lot of people will be reading this when it comes out. So thank everybody that's participated and put the conference together. Look for it when it comes out in print. And I guess it's on to the reception. There's a reception after this, and I hope everybody can stay and mingle and talk some more. Thanks a lot.
Reception is in the Great Hall. Downstairs in the Great Hall for those here. Thank you so much, everybody who came, and thank the presenters. They were phenomenal.
Sorry, I got to run.
Yeah, no,
But it's a pleasure to meet you.